Welcome back to Part 2 of Terminology in Equity and Debt Markets. In this explainer, we begin with types of bonds. You know, if you've ever felt totally overwhelmed by the sheer variety of financial instruments out there, well, you are absolutely in the right place. Today, we're breaking down everything from deep discount bonds all the way to the fascinating world of physical commodities, making sure you master these concepts both for your own real-world investing and your upcoming NISM exams.
Okay, let's dive right into our roadmap for today. We're covering zero-coupon bonds, floating and convertible bonds, structured and inflation bonds, global and perpetual bonds, commodities, and then we'll wrap it all up with a quick, rapid-fire revision.
Section 1. Zero-coupon and fixed bonds.
So to really get all these different bond flavors, we got to start at the base. In simple terms, हर लोन में तीन चीजें होती हैं. Every single loan has a principal amount, a maturity date, and a coupon, which is basically the interest rate. Now, if we tweak these variables, we get things like zero-coupon bonds, or zeros. Just like it sounds, these guys don't pay any periodic interest. None. Instead, they're issued at a steep discount to their face value and then redeemed at par. For a company issuing them, this is literally a lifesaver because there's zero strain on their day-to-day cash flows. They just make one big bullet payment at the very end. But hey, for your exams, remember this. Zeros inherently carry way more interest rate risk because of their higher duration compared to a standard coupon-paying bond. Examples? Think money market instruments like T-bills, commercial papers, and certificates of deposit. And when these are issued for really long tenures, they're called deep discount bonds. Kisan Vikas Patra is a great example of that.
Let's make this real. Back in October 2009, an SR Group company called ETEL Communications issued some zero-coupon bonds. Take their Series 1, for instance. It was issued at 85 rupees and 80 paise, but the maturity value, exactly 100 rupees. So that difference right there gives you an implied interest rate of 9.15%. मान लीजिए आपने bond खरीदा discount पर maturity पे पूरा 100 रुपये मिलेगा. You buy it cheap and you get the full 100 at the end. That is the magic of a zero-coupon bond.
All right, Section 2. Floating and convertible bonds.
Okay, unlike vanilla bonds, the coupon for a floating rate bond is not fixed. It actually resets periodically based on a benchmark, like an inflation index or interbank rates. Let's do a quick pause and think here. Imagine interest rates in the whole economy are just shooting up. Wouldn't a fixed rate bond suddenly look pretty terrible? Exactly. That is exactly why floating rate bonds carry lower price risk when rates are rising. They just track the market and bump your coupon up. It's honestly just like a home loan with a variable interest rate. Now, some of these have a cap, so a maximum limit, or a floor, which is a minimum limit. And in developed markets, you'll even see inverse floaters. That's where the coupon moves in the exact opposite direction of the benchmark. Crazy, right?
Next up, convertible bonds. These give investors the option, or sometimes it's actually a compulsory obligation, to convert their debt into equity shares of the issuing company. They can be fully convertible or just partly. But here is the absolute most crucial logic flow to understand. When that conversion happens, the debt gets wiped clean from the balance sheet. Awesome! But the total number of outstanding shares suddenly increases. And because the company's profit is now divided among way more shares, the earnings per share, or EPS, dilutes. It shrinks. So existing shareholders see their stake get smaller. For the investor, though, they're basically accepting a lower coupon rate up front, just for the chance at massive capital appreciation if they convert to equity later.
Moving right along to Section 3. Structured and inflation bonds.
Let's start with principal protected notes, or PPNs. These are synthetic products dreamed up by financial engineers. Basically, a chunk of your money is put into super safe debt just to guarantee your principal is protected at maturity. Then, the rest is thrown into high-return potential stuff like equity or derivatives, which are often called equity-linked bonds or commodity-linked bonds. But wait, here's the really interesting part, and you got to be careful here. PPNs protect your principal from market risk, sure, but they absolutely do not protect you from credit risk. If the issuer goes bust and defaults, you still lose your money. No way around it.
All right, pay super close attention to this one, because this is a most asked in exams concept. High inflation can completely eat your fixed income returns, making them negative. To fight this, the RBI issues inflation-indexed bonds, where both the principal and the interest get adjusted for inflation. But here is the massive distinction you need to memorize. For general inflation-indexed bonds, the RBI uses the wholesale price index, the WPI, to calculate that adjustment. But for retail investors who buy inflation-indexed national savings securities, it's linked to the consumer price index, the CPI. Plus, those retail ones guarantee a fixed 1.5% floor, so you're getting at least that, even if the economy goes into deflation.
Section 4. Global and perpetual bonds.
Now, what's really interesting about crossing international borders is how it completely flips who holds the currency risk. Let's say we have a foreign currency bond. That's issued in a currency different from the issuer's home country, like when the Delhi International Airport issued US dollar bonds. In this case, the issuer takes the currency risk. If the rupee depreciates, Delhi Airport suddenly needs way more rupees to pay back those dollars. But then, flip it around. We have external bonds, specifically Masala bonds. These are rupee-denominated bonds issued outside India. When the International Finance Corporation issued Masala bonds over in London, they were in INR. That means the currency risk shifts entirely to the foreign investor. If the rupee falls, that investor is getting less value in their own local currency.
And then we have perpetual bonds. Specifically, we're talking about additional Tier 1 or AT1 capital bonds issued by banks under Basel III norms. Guys, these have no stated maturity date. The issuer literally never has to redeem them. There are 5 specific risks you absolutely must know for the exam. Number 1, no fixed maturity. Number 2, they are subordinate to almost all other debts, meaning you're last in line if things go wrong. Number 3, coupons are paid only from distributable profits. Number 4, they are non-cumulative, so if the bank skips your coupon payment this year, they're not making it up to you next year. And number 5, they can be contingently converted into equity. Definitely memorize these 5 points. This is prime multiple choice question material.
Section 5. Commodity Market Terminology.
Okay, let's shift gears from the debt markets into the physical world of commodities. Everything here starts with the spot price. This is just the current market price where a physical commodity can be bought or sold for immediate delivery right now. It is purely driven by immediate supply and demand. Now, why do we care about this in finance? Because the spot price is the literal foundation for all commodity derivative contracts traded on exchanges. It's exactly what's used to determine the final settlement price, or FSP, when those contracts finally expire.
So if the spot price is today's reality and the futures price is tomorrow's expectation, how do we measure the exact difference between the two? Well, the answer is a really critical term called basis. Basis is simply the spot price minus the futures price. Just a simple subtraction. Tracking this basis is a game changer because it helps market participants understand the real-time relationship between current physical supply and future market sentiment.
This leads us right into another absolute must-know exam comparison: Contango versus backwardation. When the futures price is higher than the spot price, the market is in Contango. People expect prices to go up. But when the futures price is lower than the spot price, that's backwardation. Here is a super simple memory trick for you. Contango sounds like climbing, right? Prices are expected to climb higher. Backwardation means prices are backing down. Seriously, keep that trick in your back pocket. It helps so much.
But hold on, why would a futures price naturally be higher than a spot price anyway? Well, it's because of the cost of carry. Think about it. If I buy 10 grams of actual physical gold today just to deliver it to you in 3 months, I'm taking on real-world expenses. I have to pay for secure storage, I got to buy insurance, transportation costs, and of course, the cost of financing, the interest on the money I tied up to buy the gold in the first place. Add all of those up, and you get the cost of carry.
Let's walk through the exact math here because I guarantee this is going to show up on your test. Imagine the spot cost of 10 grams of gold is 1,002,000 rupees, and the cost of carry is 8% per annum. So what's the fair value for a 3-month futures contract? We take that 1,002,000 spot price and add the carry cost. The math is 1,002,000 multiplied by 8% and then multiplied by 3 over 12 months. That gives us a carry cost of 2,040 rupees. Add that back to our spot price, and boom, the exact fair futures value is 1,040,040 rupees. See? The formula is incredibly logical once you actually break it down.
Finally, before we leave commodities, we have to talk about delivery. Unlike financial instruments that just sit there as little digital numbers in your DMAT account, commodities are real, tangible things. If you hold a deliverable futures contract all the way to expiry, you are legally bound to either physically deliver that commodity to the buyer or accept physical delivery from the seller. This is a physical reality. It's not just a paper trade.
Section 6. Final revision and exam tips. All right, you made it. Let's do a rapid-fire revision. Take a mental screenshot right now. These two formulas, basis equals spot minus futures, and that cost of carry calculation we just walked through, they are absolutely guaranteed to show up in practical market scenarios in your NISM numericals. Practice that calculation until it is completely second nature.
Let's quickly connect the dots on all the major things we covered today. Remember, zero-coupon bonds offer no periodic interest, but they are redeemed at par. Convertible bonds give you equity upside, but they cause EPS dilution for the existing shareholders. For inflation, general bonds use WPI, but retail securities use CPI with a 1.5% floor. Masala bonds shift the currency risk completely away from the issuer and onto the foreign investor. AT1 perpetual bonds, extremely risky because they are non-cumulative and subordinate. And in commodities, Contango means futures are climbing higher than spot, while backwardation means they're backing down.
So, have you mastered these market mechanics? Because you are now fully equipped to decode real-world bond prospectuses and completely ace your NISM exams. But I want you to consider this for a second. If financial engineers can literally create a bond out of thin air that profits from inflation, or a perpetual debt that never actually has to be repaid, what other hidden financial levers are shaping the economy around you every single day? Think about that. In the next chapter, we'll continue building deeper understanding of financial markets.